Hello, my name is Claudia Zeisberger. I'm a professor of entrepreneurship at INSEAD, where I focus on private equity and venture capital. If you are intrigued by the world of PE and VC, then this video channel is for you. I will start with a high-level introduction of the institutional private equity market, and the first lectures will apply to both early-stage venture capital funds as well as late-stage private equity funds. In part one, we will start with a broad market overview, and we will see how private equity really has grown from a cottage industry in the 70s and 80s to a very fast-growing environment and a very important asset class for all the LPs. So what we see here is the growth or the development of the public equity markets in the last 2 decades, from 2000 till 2019. So I've indexed the data for private equity to 2000. So let's have a look how private equity has grown over the same time. As you can see, the value of PE-owned companies has grown more than 8-fold in the last 2 decades, by far outpacing the public market equities growth. Now, being realistic though, in terms of total assets under management globally, public debt and public equity by far still outpaces the private market. So even if I include infrastructure, real estate, and private debt into that. So let's have a closer look at private equity in the financial market context. So here we look at the various asset classes from real estate, commodities, debt, and equity. And as you can see in the green box here, this is where private equity sits. There we also have angel investing. We will not tackle this in the context of this video lecture. But because angel investing does not fit into the institutionalized space of private capital. And obviously down here we have the capital markets, meaning the public equity markets. Investors in PE and VC funds are sovereign wealth funds, pension plans, university endowments, investment banks, high net worth individuals, and nowadays at times even retail investors. We have seen products or platforms being launched that allow retail investors to allocate to private equity, usually with pretty steep fees, but we should mention that as well here. So let's have a look at the private capital space. So this is only venture growth buyout from 2000 till 2019. And as you can see, it's grown about 7 times. If I now add to that the distressed private equity funds, real estate funds, infrastructure, natural resources, mezzanine, direct lending, co-investment, and secondaries, the growth rate has been about 10.5 times in the last 2 decades. So that is clearly impressive for the private equity space. Now, private equity around the world it can be quite distinct. So what I've done here, I just simply look at the total assets under management in percent, and I'm asking myself how much of the total AUM in the various regions around the world are invested in buyout funds, venture capital funds, the red box, and growth equity funds. So what are growth equity funds? Whilst buyout and venture is often quite well known, growth equity funds are private equity funds that invest in fast-growing companies, so not in startups. Often those companies are actually quite profitable, but private equity invests and acquires a minority stake, so not a buyout. They're a minority investor in those fast-growing companies. More often than not, they are being invited to invest not so much because of a need of capital, but much more because of the experience and the talent that they contribute to the portfolio company. Now, as you can see, the US and Europe are reasonably similar. So we have a very reasonably large 70 to 80% of AUM invested in buyouts. whereby in Europe, the majority of those are mid-market buyouts, meaning smaller companies that are being acquired by private equity, whilst in the US, the buyout side, by far the largest percentage of AUM, is allocated to very large buyouts. We then have some growth equity happening. And obviously, we see more venture capital in the US than we see in Europe. No surprise there. Now, when we look at Asia and Latin America, the two examples that I rolled out for emerging markets, you can see that Asia is about 1/3 buyout, 1/3 growth equity, and then 1/3 venture, which is quite surprising. Let me start with venture. The venture side, by far the majority of that venture bucket is venture capital in China. So this graph would have looked very different even 4 or 5 years ago. So nevertheless, also I should say, in Latin America, and I basically did this graph in, it's a best guess, I would argue, together with the Latin American Venture Capital Association, by far the majority of deals, private equity deals in Latin America, are growth equity deals. And we see some buyouts and a little bit of venture capital happening. But in terms of percentage of AUM, the majority is invested in very often family businesses, very often second or third generation family businesses that are just not willing to give up majority stakes. Now, in private equity, and the data you're looking at here right now is purely venture growth and buyout. What is being very often discussed is the dry powder. Dry powder being defined as the capital that has been raised by private equity funds, but is still waiting to be deployed. And as you can see, we have right now about 1.5 trillion US dollars sitting on the sidelines, waiting to be invested in venture growth or buyout deals. So that's a substantial amount of capital, and it has given the press a lot of food for thought. And it's being discussed quite regularly. Nevertheless, let me just add, the industry as a model can never run out of dry powder. So dry powder will de facto never go to zero. Now, where is dry powder usually? As the AUM, the total assets under management in private equity, has grown, no surprise, dry powder has grown as well. And usually dry powder over the last 20 years has been somewhere between 25 and 35% of total AUM. So right now we may be upper bound of that range. Nevertheless, we're by far not in, let's say, extreme territory. Now, of course, you can imagine more money coming to the market, more dry powder, looking for suitable, attractive deals that has an impact on pricing. And as we have seen, the increasing competition has clearly in the last 8 years driven up the multiples, EBITDA multiples that private equity firms are paying on entry when acquiring portfolio companies. So on a global basis, 11 times EBITDA, 11 to 12 times EBITDA seems to be right now the number to go for. Clearly, this was initially the same on the M&A side. M&A we've seen tapering off in the last 2 years. So we will need to see how this will evolve further as more money is being raised by private equity. Nevertheless, you will appreciate more capital joining in, looking for attractive deals has an impact. So, and no surprise that PE returns have started to taper off. Now, if I look at the average over the last 2 decades on a decade by decade comparison, then the last decade has still been attractive, no doubt. Nevertheless, LPs asking questions as well. Can private equity continue to deliver the returns that it has delivered in the past, given that we have so much capital basically looking for attractive deals? Now, what actually is private equity? And this is just a sampler for the upcoming lecture. Private equity is a simple business. You acquire an equity stake, whether it's a minority or a majority stake, at this point doesn't matter. One grows the company and one exits the company, all within the lifetime of one fund. Obviously, one hopes to exit at a profit. And obviously, there's a lot more to be said when it comes to buying, growing, and selling. Nevertheless, what we will do, we will have a closer look at the investment process in our next session, where we look at the nuts and bolts of private equity investing. So, what have we learned in our session today? We had a look at the public equity markets versus the private equity markets. We took a closer look at the growth and the development in the last 2 decades. We understood that there's plenty of dry powder, and that dry powder in the industry has had an impact on the valuations that private equity is paying on entry. And we have understood that private equity is a simple business. We buy, we improve, we sell. If you like this session, give it a like below, and join me for the second session, where we have a closer look at the nuts and bolts of private equity.